Hello, everyone. It's time for us to continue on with our second lesson. So once again, I would like to welcome all of you. And without further ado, let's get started. As usual, every lesson will have a disclaimer. I read the disclaimer to you during the first lesson. I will not read it during every other lesson, but what I would like you to do is always take time to read it, to become familiar with it, and to understand what it says. We have a lot of territory to cover today. Basically, we are going to tackle two important topics. First and foremost, we're going to look at market charts and graphics in general. And then we are going to get into what I call the anatomy of the market profile graphic, the building blocks, the very first and preliminary steps for someone to understand and work with the profile. All right, so let's talk, before we get into the profile, a little bit about market charts and graphics in general. I'm sure that you are all aware that there are a bunch of different ways, a lot of different varieties, by which we can take a look at market information and market data. And I never like to sort of point to one and say this one is good, this one is bad, because each one of these types of graphics has its own inherent advantages, and of course, it also has some disadvantages. Now, I haven't even listed all of the different types of graphics that are available on the market. I've just selected a few here of the more common ones to give you a flavor about what's out there, and also to give us an opportunity to be able to compare what the profile shows us versus some of these other common graphics that people tend to use in the business. So let's just quickly review together. We have line diagrams, we have bar charts, we have candlestick charts, we have boxes or range bars, we have point figure charts, we have Renko charts. Now, it's not enough just to simply give you a name. I always like to at least match the name with a picture. And here, the picture that we're going to look at together is a picture of a line diagram. Line diagrams are important, and I will show you some cases in this course of how I use line diagrams and how they help us in conjunction with the market profile. But basically, the focus of a line diagram is really on the close, where each day closed. When we're looking at a daily chart here, or whatever time period we're looking at, it's the close that we're after. And watch what happens from one close to the next. Prices moved up here, prices continue to move up, and then we get another close here. So really, it's a simple way of giving us a graphic to track what's happening on the market based on the close of each period. Very simple and very basic graphic. Now we get to another popular graphic, which is a bar chart. And the bar chart is also another simple way to look at prices, but it has a little bit more information than a simple line diagram. First of all, notice that we have some green and some red bars. So right away, the color is telling us something. A red bar is one where there was more selling in the market. A green bar is one where buying took place in the market. So right away, simply by just looking at the color of the bar, I can extract some general information about what's going on. Then there are some other interesting things. I have a low for the bar. I have a high for the bar. I also have an open, and I have a close. If my open is higher than my close, then obviously this was a down bar or a negative bar, or there was selling in that bar. The next type of chart that is common in the business, and we see a lot of people using it and has become very popular, are candlesticks. And candlesticks convey to us a little bit more information than a line diagram and a bar chart. They come to us from the East. The Japanese in particular developed the candles, and they are a very powerful and helpful tool. So I don't want you to discount them, but I want to show you how they compare to a profile and where the profile shines and what additional information a profile offers versus simply looking at a candle. And I'm going to devote at least 1 or 2 lessons specifically for candles because they are very, very important, and we will go into depth in them. But at this point, I just simply want to point out for you once again the changes in color. A red candle tells us, I included a little green one here, I didn't mean to, but let's focus on the red candle, that this was a down day or a day where there was a lot of selling, and so it opened up here and closed down here, so the close is below the open, and therefore it is a negative candle. It also shows us the high for the day, and it shows us the low for the day, the range of prices for that day. Similarly, if we take a green candle, and this time I'll only include 1 green candle, same thing, it opens down here, and then it closes up here, and the high is up there. So it gives us an idea about the range, it gives us an idea open, close, and it's green, so obviously this was an up day or a day where buying was the prevailing action in the market. Now we get into another type of chart, which is called the box or the range bar. And here, unlike a candle, we don't look at low and high, we simply look at the range. Where did prices begin and where did prices end? So if prices started here, that's the beginning of the range, and they ended here, then this is my range for the movement. And if you notice, since my close is higher than the open, it is obviously an up day. And this helps us to sort of see trends a little bit more clearly. We don't have any wicks as we did with the candles, and we don't have an indication of where the open or the close was. We are simply looking at price range movement. And that can also be very helpful for us in some instances. All right, now another very popular and perhaps one of the oldest types of charts out there. Certainly this was commonly used in the early days of the stock market development, a point and figure chart. The point and figure chart is kind of like an XO game. The interesting thing about the dynamic here is that the chart does not look at it doesn't look at time as a variable. It strictly looks at price movement. What is happening to price? And show me on the chart certain movements that I set based on my settings to determine when I'm looking at a major price change in the market. So there's a little bit of an art and a science to using this form of charts. And for me to be able to see what's happening in terms of volume, I also have to have a volume indicator, as we do down here below the chart. Point and figure charts are very powerful. If you understand them and you know how to use them, they can be incredibly helpful. So I don't want you to discount any of these tools. I want you to be aware that they're out there, but more importantly, I am going to show you how the profile is different from some of these tools and how it adds to them and gives us an additional perspective or more information that we cannot extract from these types of charts. Another interesting type of chart, which is sort of in line with a point and figure, in that this type of a chart, which is called a Renko, and Renko, once again, is a Japanese word. It simply means a brick. And if you take a look at the chart, it looks like it's made up of a bunch of bricks. And this type of chart is one of the best in terms of helping us see price trends in the market. If you notice, it really outlines or identifies for us trend movements rather nicely. We have solid bricks and we have hollow bricks. That's what make up the chart. And once again, it is looking strictly at price movement in the market. It is not based on a set time period. It is based on a certain level of price movement in the market. Another interesting type of chart. All right, now we get to my favorite type of chart, and certainly the chart that has brought us all together, and it is the market profile chart. If you notice, this chart looks very different from all the others. In many ways, it has a lot of the same basic information, but it allows us to begin to look at it in a very different way. And it behooves us to spend just a little bit of time before we get into the anatomy of the profile chart to talk a little bit about the reasons or the development process of this particular technique. It's interesting that this charting technique was actually developed by the CBOE, the Chicago Board of Exchange, and it was originally developed for the commodities market. And the idea behind the market profile was to actually create more transparency in the market, to allow people to have a visual interpretation of what was actually happening in the market to help them in their analysis of the market. A lot of investors and a lot of traders felt that if in fact you were at the pit or on the floor of the exchange, you had a significant advantage over anyone that was not at the exchange, because you were able to get a feel for the actual market activity. I don't know if any of you have ever been on the floor of any exchange, but certainly there is a feel for what is going on in the market when you are on the floor. And as a matter of fact, there is a service, I can't remember the exact name of the service right now, but if any of you are interested in it, I'll send you a link to it, of a gentleman providing a service that actually calls what he sees in the market to simulate for listeners. I think it's called Squawk Box or some sort of an audio, to give you an idea about what's happening in the pit and the auction process. So if you are on the floor, you are able to observe what other traders, what the key players are doing, and therefore it makes it much easier for you if you see a large or a major player buying an item and you decide, well, I might as well buy with them, you're probably going to profit. It should not come as a surprise or as a secret to any of you that certain market players have a lot more influence on the market than others. This is just a fact of the business, and it should not bother or hurt you in any way. Actually, it helps us in that if we can identify and understand what the different participants in the market are doing and follow in the footsteps of the participants that actually influence the market, we are that much further ahead. So when you hear people talk about, well, the markets are manipulated or the markets are influenced, well, you know, it's just part of the process. If you have a lot of capital, you are definitely going to have a lot more influence on the market than if you don't. And as small individual traders, we always have to appreciate our size and our ability to really impact the market in any kind of significant way, because the small trader or the individual is a very, very minute and a very small part of the big picture when it comes to the marketplace. So back again to the idea behind the profile. The idea was to try to share with other people that were not on the floor information that seemed to only be privy to the people that were on the floor. And their feeling was at the Board of Exchange when they developed this technique that if we create more transparency and share more information, we would be able to attract more traders, more investors, more capital, and it would certainly strengthen our exchange and generate more liquidity in the market. So that was really the thrust of why the market profile was developed, to help promote trading in the commodities market and to create more transparency and to sort of address the issue of criticism in terms of some traders really having a lot more of an advantage over others. If we perhaps exchange and share more information with everyone, then we can create a more level playing field for everyone. All right. If you notice, there is one thing in common behind all of the charts that we've looked at, including the profile. There are always three key things that as traders we are focused on, and we should be focused on, and we should always hone in on: time, price, and volume. Keep those in mind. You always want to be looking at time, price, and volume. Regardless of what chart you look at, those are the key elements for anyone analyzing a market to look at. Now, why those three key items? Because these three items will allow us to get a handle and to understand what is going on in the market. And that's really what we want to know as traders. We want to get a feel for market activity. What is happening? Where is it going? What is the sentiment of the market? What are the different players in the market doing? And we play a little bit of a detective role. We look at those three elements and we're trying to find out and discern what is happening on in the market based on activity in these three elements. Now, what creates market activity? Well, it's participant behavior. You will often hear many people talk about candlesticks in the context of that candles reflect for you what people are thinking or reflect for you behavior. And you'll often hear that markets really are about human behavior. Well, there is a lot of truth to that, because any decision that's made, whether to buy or sell in the market, is going to be made by a human, even though at some point the strategy used or the approach to implement the decision may be turned over to a machine, meaning a computer or a computerized algorithm. But nevertheless, someone has to create the program, someone has to create the strategy for the program, and the decisions that govern how the program will function in the market are going to be made by humans. So even though there is a great deal of involvement of automation and machines in the market, you always have to remember that it is some human behavior that is controlling or programming these particular machines, and we can still read, understand, and discern this behavior from analyzing and looking at the market, even though it may actually be executed or implemented using a machine. All right, now having said that, I think it is time for us now to begin to take a look at the profile. And so we get into what I call the anatomy of the market profile. We're going to dissect together the profile into some small pieces, and then these pieces will help us in the future as we develop our understanding of the profile and begin to analyze the market using the profile. First and foremost, and this is really the key element or the building block of the profile, a time price opportunity, a TPO. A TPO is an opportunity that is created in the market at a certain time at a certain price. Now notice and look carefully at the definition. It is an opportunity. It doesn't necessarily mean that either a sale or a purchase occurred. So the market hit a price, and sometimes the market may in fact hit a specific price point at a point of time, and the bid and the ask do not meet one another, and so we don't have a transaction. So I want you, first of all, to begin to develop the appreciation for the fact that you don't want to strictly focus on price. A lot of people, unfortunately, make the big mistake of only looking at price as the key element on a chart. And first of all, I want to wean you away from that. You never want to base your analysis strictly on price. You want to look, first of all, at time and price, and then more importantly, volume. And we are going to spend a lot of time talking about this combination. It is really sort of the foundation of everything that we're going to be talking about. So let me review again. A TPO is the most basic unit of the profile. It is simply a point in time where the market hits a specific price at that point in time. No transactions necessary, no volume, nothing. Just a point in time when the market hits a price. So here I identify for you several TPOs in the circle. But primarily I want to show you that there's a letter J and there's a letter K. So what this tells us is this price, which we see right here, 1265.75, was hit twice in this session. The market hit this price at two different times during this particular day. One time we got a J print, and another time we had another TPO, which was the K print. Now, take a look with me again here. At this point, we just have one print at this point in time, and the price that it printed at was 1265.50. This time, it only had a single TPO. Now, on the chart, we have lots of TPOs. Each TPO, or time price opportunity, is represented by a single letter. Let me review again, because I want to make sure that you have a very clear understanding of these TPOs. So, a TPO is the building block of the market profile. It is my basic unit. Every time the market touches a price, the market profile chart will print a letter at that point. Each 30-minute set of TPOs is represented by a different letter. Now, here's an interesting point. Why 30 minutes? Why not 60 minutes? Why not 5 minutes? Why not 10 minutes? Well, this was one of the key decisions that they had to make early on in developing the profile. And let me share with you some of the thought behind it. As humans, if you think about it, we tend to think of time in half-hour increments. If I were to tell you, what time are you going to have lunch today, for those of you who haven't had lunch yet, and for those of you who have already had lunch, I might say, what time are you going to go to bed? And usually the thought that will come into your mind will be either 9 o'clock, 10 o'clock, 11 o'clock, or 10:30, 9:30. I don't think you're going to find very many of you that will say to me, well, I'm going to go to bed tonight at 10:03 or at 10:04. That's not how we tend to think as humans. We're going to think in increments of an hour or half an hour or perhaps 15 minutes. They decided that the 15-minute increment was not significant enough in the, of an amount of time in the market, and 60 minutes was a little bit too long, so they decided to make the standard period in the profile as 30 minutes. Now, having said that, I don't want you to think that that is etched in stone, and you will see as we get into some of our strategies, we are going to manipulate that a little bit, and we're going to look at different TPOs for different time frames. And with our software, we have the flexibility to do that. We're going to be able to look at 10-minute ranges, 15-minute, we can do 7-minute, whatever time frame that we choose. But the standard profile, as it was designed, is based on a 30-minute period. And every 30 minutes, the profile gives us a range of TPOs. This range is going to vary, of course, for each 30-minute period, and we are going to learn to sort of how to interpret and understand some of these variations and how that tells us valuable information about what is going on in the market. All right, I have before you here just a simple profile, but the profile is a split profile. And if you notice, the profile has the letter A, the letter B, the letter C, D, E, F, G, H, I, J, K, L, M. All right, so I should have about 13 profiles there. That is a full day of trading. Now, when we spread them out apart like that, you can really see the range for each TPO, and you can see, for instance, here's where the market opened for range A, or the first 30-minute, and here's where the market opened. You see that little O there for the second 30 minutes. Here's the other opening up here for period D. Each of these TPO ranges is a 30-minute period. Now notice, each of these ranges also has a different range. The biggest range here is our A period, or the first range of the day. And the smallest one was the H range here, if you will look at that. Sometimes it helps us when we analyze a profile to split the profile up, as you see here, and I will show you how to do that when we get into the lab and take a look at the software and begin to learn some of the analysis techniques that we will cover. But for now, at least, I hope that you are all on board with me with how to identify a TPO and how to identify a specific time range or a TPO range on the chart. Another term that we use for the TPO range is a period. A period is a group or range of TPOs for a specified time interval. Once again, if you hear the word period, do not get confused. It's the same exact thing as a range. So we have 13 periods here, or 13 different ranges. Same exact terminology, just a different way to describe the same phenomena on the chart. This is our A period, to review again, our B period, and our C period. And you go on down the line throughout the rest of the day. You know how to identify the open now. And another interesting question I might pose to you, which should be somewhat intuitive, but sometimes I get asked the question, well, where is the close? If this is my open, where is the close? Well, the close is obviously A closed here because this was the open for B. So this is the close for A, the open for B, and the same thing, this was the close for B, the open for C, for the C period. Now, it is always important on any market profile to note and to keep track of the open price for period A, because that's typically the beginning of any session. And the way that we identify the price is simply by going over to the left-hand side, directly in front of the TPO that we're interested in, and this is the point, the O, where we open, and look at the price and identify the price that way. Market delta gives us the flexibility of also having our prices placed on the left side in addition to the right side. And I will also show you how to do that, just sort of an additional way to keep us focused on where prices are. All right. Here on this chart, I simply want to share with you the same exact image, but in two different formats. On this side, on the right-hand side, oops, let me go back. On the right-hand side, here we have what I called the split profile. Our periods or our ranges are each split. Now look here at the actual profile as it is intended to look. All of them are brought together, squeezed together. And this gives us some very interesting and some very valuable information. And this is really where the meat of the course is going to be. What does this all mean? At this point, we are only looking at the building blocks, the elements, the small pieces of the puzzle, and then we will begin to put them together. And then once we have them together, we will begin to interpret and analyze what do they really mean. All right. Another key term I want you to be acquainted with when you look at the profile is the initial balance. And what is the initial balance? The initial balance is the range of price movement that occurs during the first hour of the trading day. And I will quickly ask you an easy question. How many periods is that? The first hour of the trading day. How many periods? And you can feel free to write the answer in your chat windows. And I will give you the answer, of course. The answer is the first 2 periods. Because remember, our profile is based on 30-minute periods. So each period in the profile will represent 30 minutes. That's the standard format. And if I tell you that the initial balance is the first hour, then obviously that is the first 2 periods of the day. Now another easy question, well, which 2 letters then would those be? The first 2 letters of the day. And hopefully this is a really easy question. It would be letter A and letter B. And if you take a look at the chart that I have before you, it shows us exactly what I just described. This is our initial balance. Now, in many markets, you will find that this is a very important period of the day. Often, our highs and our lows for the day will be put in during that period. So in other words, during that first hour of the day, you are either going to see the low of the day or the high of the day. So this is a very important interval to pay attention to in terms of what's going on or the type of day that's occurring in the market. The initial balance. Now, the next thing that we want to study and learn about is the idea of a range extension on the profile. Now, what is a range extension? It's simply a price movement that extends beyond the initial balance or beyond a specific period. So the first range extension that we might have is usually the one that occurs beyond the initial balance. But that doesn't mean that that's the only range extension that we could have. We could also have range extensions beyond a specific or a set period on the chart. Now let's take a look at them here and see if we can identify together some of the range extensions that we have. Well, it's the same profile that we've been looking at, and we've identified the low and the high of the initial balance, okay? But we haven't identified the range extensions. Let me identify them for you. Okay, our first range extension actually occurred after the first half hour. So period A started, we opened down here at about 1263.25, and prices moved all the way up to this point here, which is 1267.75. And then when B opened, B dropped down a little bit, and then we got a range extension. B continued beyond A. When we see that in the market, what is that really telling us? Well, it's telling us that the market is bullish. We are getting a range extension in the upward direction. We could just as easily have had a range extension in the downward direction, and therefore this would be a bearish indicator. But in this case, since we're extending price to the upside, this is a bullish movement in the market. Okay. Often I will get the question, well, do I buy? Do I buy? Is this when I buy? The answer is, don't be thinking about buying or selling at all right now. Again, remember when I told you one of the biggest misconceptions about the market profile was that it gives us signals? Again, people that come in with this program mindset, okay, here's the signal for me to buy, here's the signal for me to sell, never really developed the understanding that I want you to develop in terms of using the profile. This is not how we use the profile. We are first learning how the profile comes together. Then when we begin to understand how it comes together, we will be talking and we'll spend a lot of time on what constitutes a reasonably good point to buy, what constitutes a reasonably good point to sell, and so on. So I don't want you to jump the gun on me, and I know I'm almost willing to bet money that someone in the room was thinking that, is this where I buy? Is this where I would get into the market? I have taught this so many times, and I've spoken to so many students, so that's why I always like to address your thoughts. I wish I could predict the market as well as I could predict my students' thoughts. Anyway, so do not be thinking at all at these points, is this where I buy or is this where I sell? Please focus with me on understanding what is happening with the profile and interpreting. So all this really tells us is that during this period, we had a bullish extension in prices. You have to remember, what if we didn't have the volume to support that? Then this would have been crazy to buy at that point. You would buy only to see prices start dropping. So that's why when you don't have all the pieces, do not rush. Be patient. There's a lot of great stuff here, and we'll get into it piece by piece. All right, and next range extension is the C period, and notice how it takes me even above the initial balance. So this is definitely a bullish day. Now, my third extension doesn't happen in the D period, in the fourth period. On the contrary, D period, we had just a tiny little print outside the range, and a lot of amateurs would have been thinking, aha, this is the point I sell. The market is going to drop now because it hasn't, the range extension has stopped. Again, this is someone who's looking for buy-sell signals, not someone who's analyzing what's going on. Let's continue with our analysis. A range extension actually takes place in the E period, and that's where we arrive at our high. Now I'm going to give you just a quick sneak peek at some of the other interesting things that we'll talk about because it's right here in front of you. Take a look at my volume on the right-hand side. Notice how little volume I had up here. Okay, keep that in mind. We will certainly look at that in much greater detail. I just wanted to show you that there's a lot more to this picture than meets the eye. Okay, the next concept that we want to discuss in the anatomy of a profile is what we call a pioneer range. And actually the term pioneer range comes to us from Stadelmeier, who was the developer of the profile. Peter Stadelmeier defined a pioneer range as the range of TPOs that print the first time a price is hit in a session. All right, since a picture is worth 1,000 words, let's actually take a look at what a pioneer range means. We have two pioneer ranges here. First of all, when we only had the A period, those were all brand new TPOs in that session, and therefore they gave us our first range. And that was, in fact, a pioneer range. The second pioneer range we had was when we got into the B period and we started a range extension. And as we got into this range extension, prices went into some new territory. That's the first time that they hit this price range in this second Pioneer range. So in this picture before you, you actually see two Pioneer ranges. All right, another important concept that we want to make sure that we have under our belt in understanding and analyzing a profile chart, the single print buying tail, and in a couple of moments we will also talk about a single print selling tail. A single print buying tail indicates the presence of aggressive buyers in the market. It is important to keep in mind that we don't want to just look at any tail. We want that our tail needs to be at least 3 TPOs long. And the longer the tail, the stronger the activity. Now let me backpedal a second and get you thinking about what we talked about when we talked about the auction markets. Does anyone remember or recall what was the characteristic of aggressive buyers in the market, in an auction market? How did we identify these buyers? Great. Okay, I've got a few people giving me the answer here. Good. I'm glad. It looks like you've reviewed your first lesson. And the answer is aggressive buyers are always buying at the ask. They are aggressive. They'll buy at any price they can get. And this is what a single print buying tail is telling us, that aggressive buyers are in the market and they're buying at the ask. And look at what happens when that takes place. We get this nice little tail that you see here. So they're gobbling up the prices. And it takes us upwards with the price movement. That's what a buying tail looks like. Now, I told you we would also talk about a single print selling tail, and really it's simply the reverse of what we just talked about. A single print selling tail indicates the presence of aggressive sellers in the market. And once again, not just any tiny little tail, the tail needs to be at least 3 TPOs long. The longer the tail, the stronger the activity. There's another point that I want to bring to your attention also about these tails. If these tails begin to occur towards the end of a session, be careful, because these tails that occur at the end of the session and then all of a sudden the market closes don't give you the full picture. It could have just been some activity, last minute activity, but really there's not going to be much follow through on it. So we always want to be very cautious when we see tails at the close. You will always, well, I don't want to say always, but certainly you will often see the most potent tails at the beginning of the day. Now, let's look at some selling tails together, and let's take a look at how many prints we have. Our first selling tail here on the chart is the A period, and this is the beginning of the day. Now, the day didn't begin up here at the top. Look at where the day opened. The day opened here. And we had a rather wide initial balance. Take a look at that. All the way down here and then all the way up here. But when prices navigated upward and they got to this level, look at what happened. We get this selling tail. Okay, and what does that tell us? We've got some aggressive sellers in the market. How many prints? We have 1, 2, 3, 4, 5, 6, 7, 8, 9. If I counted correctly, 9 prints. Okay, that's a fairly aggressive selling tail. Not to mention, look at not much volume up here. So look what happened. Prices, in fact, did drop and continued to drop during the next periods. Now, in this second day here, let's take a look at it. All right, what happened is we also got a little bit of a selling tail when we got to this price level, but look at how small this tail is. Okay, this is a bunny rabbit tail. So just 3, and even with that small selling tail, I still did get a little bit of selling activity, but notice it brought me down to about the same level where I was yesterday. Didn't take me much further than that. So a small selling tail. All right, now we get to the 3rd day, and I didn't have enough room on this chart to show you, wow, take a look at this selling tail here on our 3rd day. Okay, our 3rd selling tail. How many prints? We have more prints than you see on the chart. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. Oh, I get tired. So many prints on that selling tail. So obviously this was a down day, and we saw quite a bit of downward pressure on prices. I hope you're starting to get a flavor for the beauty of the market profile, and how just some very small basic concepts about the profile help us to get a really nice understanding of what's going on in the market. All right, we talked about the selling tails and the buying tails. We also use different terminology to describe these same phenomena. You will also hear the terms unfair highs and unfair lows, or accepted or rejected prices. Really, folks, we're talking about the same exact thing. What happens when the price reached that point and we got a selling tail is that the market perceived these prices to be at an unfair high. They were too expensive for the market. Some seller decided to come in and start selling. We had supply in the market. The price was high enough, it attracted sellers. Back again to our laws of supply and demand that we talked about in the prior lesson. Now, unfair lows, well, same thing. The prices dropped so low that there was a market participant, someone in the market that decided, aha, I'm going to come in and pick it up at this low price. Demand was generated because the price was so low. The law of demand kicked in. So these very same pictures that we were looking at, we can look at them and use a different vocabulary to describe them. But really, we're talking about the same thing. Here's an unfair high. This was an unfair high. And sure enough, the market decided that even these levels here were representing an unfair high in the market, and prices continued to decline. Similarly, we have a buying tail here, or an unfair low. The market opens at this point and it drops, but somebody picks it up real quick and runs up with it. And sure enough, okay, we have an up day. Our close was fairly higher than our open. Not much of a range, but we did get an upward movement. This was what we would call a buying tail. It also, we could describe it as an unfair low or price acceptance. The market loved and accepted these prices and decided to take them higher. All right. Now we get into one of the most important concepts in the profile, the value area. This concept is really very important because it begins to show us why the profile is really a very different way of looking at the market and varies significantly from all the other charting techniques that we were looking at. I mean, some of you could argue and say, well, guess what? The wick on the candle, there's my buying tail, there's my selling tail if we look at the wicks, and I can get the same information from a candle. But here's some very important information that you are not going to be able to discern or identify from any of the other charting platforms or forms out there, and that is the value area. So first we will talk about what the value area is, And then we will talk about why it's important and how this helps us in our analysis of the market. All right, so what is a value area? Well, now we need to go back again for a moment and review some of the concepts that we covered in our first lesson. Remember when we looked at the normal distribution? Well, the value area is based on the concept of the normal distribution. We have a lot of data in the market, and now we're going to begin to analyze the data that we're getting from the market on the basis of a normal distribution. So by definition, the value area identifies for us the area where the range of prices that includes approximately 70% of the trades have occurred during any defined session. All right, this is our value area. Now, it may seem a little bit abstract, but let me quickly show you what it looks like on a chart, and I'll talk a little bit more about why this concept is so important and why it makes sense. And I will give you examples from general life why we all need to understand value and why our buying or selling decisions have to be influenced by value in the market. Right here is the value area as defined by the profile between these two green lines. So this value area represents 70% of the activity that occurred during that session. And this chart is fairly recent. This is the activity that occurred on January 4th of this year. Back to what we covered in our first lesson, the normal distribution. If you notice, what Stadelmeier did is he took the data from the market and applied the normal distribution concept to it. And that's why if you look at the profile, this is kind of what it looks like. He put the data into the standard normal distribution curve and basically was able to identify the value area for us based on the two standard deviations. And then we identified that this area here will include, on the normal distribution, it's about 68% of all data. On our profile chart, we just approximate that to 70%. So instead of taking a look only at 68%, we actually look at the interval that gives us 70% of the data, and that represents the profile. But more importantly, why is value important in any market? Why do we care? Why is this so significant, and why is this such a powerful concept when it comes to analyzing and understanding the markets? Well, I want you to think with me for a moment. If you're going to go buy anything of any significance, do you really not want to know what kind of a value you are going to receive or you're going to get? Let's say you decided to buy a beautiful home, and someone came to you and said, this home is $700,000. Well, is it really worth this money? Should you pay $700,000 for it or not? In order to be able to answer that question with any kind of intelligence, you really have to do a market study. You have to take a look at the market and determine where value is. Well, how do I do that? Well, in the real estate business, the way you would do it, as with any other business, you would take a look at the market and see the values at which comparable homes sold during a recent period. And I did just that here to give you an example of how value influences our buying and selling decisions. In the market that we're looking at, the homes that sold, we had 12 sell for $800,000, 15 at $600,000, 22 at $500,000, 45 at $450,000, 18 at $300,000, 14 at $250,000, and 8 at $225,000. So obviously I had a bunch of different prices in the market. So this $700,000 home that I'm looking at, is it worth it or not? Well, let's go a step further and apply the normal distribution idea to this market that we're looking at. And you will quickly see that there's a mean in the market. That is sort of the average price in the market, $450,000. So if I end up buying this home at $700,000, are there any problems with that? Well, yes, of course. If I try to sell it, how quickly do you think I'm going to be able to sell it? There is a basic rule in real estate. You never want to own the most expensive home on your street because it'll be the last one to sell. The value of the area that you're in is far less than what your home is worth. So you are at a disadvantage. So the concept of value helps us in is identifying where is the best area where buyers and sellers can meet, where we can conduct business. How's that helpful? Well, it's very helpful because of liquidity. It allows me to move my assets quickly if I buy and sell within value in the market. If I'm buying something way out of value, I paid way too much for it, well, I may never be able to recover what I paid for it. It may take a very long time for prices to reach this high level that I bought at. And the same thing, if I sell something at a bad price, I won't realize the full potential of the asset that I have. So whether I'm a buyer or whether I'm a seller, I always need to have an understanding of the value in the market. Where is fair value? Where is the market value? And this is the area that I would feel comfortable trading in. That is, of course, if I'm a value player. So that is not necessarily what I'm going to tell you to, or I'm going to advocate that you do. You always buy within or sell within value. On the contrary, but this is how we are going to analyze the market. Obviously, if I can find opportunities that are below value, and this is those buying tails that we were looking at earlier, those would be good buying opportunities. And similarly, if there are selling tails, those are at the extremes up here, and they're good opportunities to sell. So let's review some of these key concepts that we just discussed. Market value is the value point where the market has found buyers and sellers equal in strength. And if you think back again to what we talked about in terms of the laws of supply and demand and points of equilibrium, these are points of value in the market. See how the concepts tie together? Now, the area where prices are accepted by buyers and sellers is the area that creates the value area for us. So once again, value is a function of the behavior of market participants. Market value also identifies for us the area of the greatest or the most liquidity in the market. And liquidity is the lifeblood of any trader. You never, as a trader, want to get into a market that is not liquid because it's very difficult to get out when you want to get out. All right, so let's take a look here at two value areas. And notice, you're never going to have to actually do the calculation to identify the value area on your profile. Thank God for the software products that are out there that do this for us. And certainly you will find Market Profile will easily identify, Market Delta will easily identify for you the value areas for each trading session. And here I have them outlined by these nice coherent green lines. Now I want you to see how each of these value areas are really quite different in shape and look from one another. That's all I want you to know at this point, that not all value areas look the same. Now here, look at the size of these different value areas. We're going to spend a lot of time together talking about value areas and interpreting what these mean and what is happening to value here. It really should not be difficult for you to see value is dropping on this chart. All right, Another important concept that I want to talk about today, and I see that I'm running a little bit over, price point of control, our POC. The price point of control is the longest horizontal line in a day's profile. A prominent POC is always unusually wide. Now, take a look here. I'm going to identify them for you. And once again, the software will highlight all these POCs for you. Okay? And the easy question I'm going to ask is, which is the most prominent POC on this chart in terms of the red lines? And of course, it is this one because it has the most prints. Why is this significant? To be continued. I will tell you in future classes. Okay, so the volume point of control is the longest horizontal line in a day's profile. This is another point of control that I want you to also be able to identify on the chart. The one that we just looked at together was for price. Now we're talking about volume. So there are two different points of control on a profile chart. One is for price and one is for volume. And here I'm going to show you first the volume, because we're talking about volume now. It's these two black lines. This is the value for volume. And then look here between the green lines. This is price, value area. The red line is the price point of control, and the black line here is the volume point of control.